The Ontario housing market is experiencing something we haven't seen in 35 years. We're talking about a complete systematic breakdown that's reshaping not just how people buy homes, but how an entire province thinks about home ownership, investment, and economic stability. Toronto's condo market just recorded its lowest sales volume since 1989. Just 319 new condo sales across the entire Greater Toronto Area in Q3 2025. That's not a slowdown, that's a complete market freeze. Meanwhile, buyers are walking away from signed contracts at rates we've never seen before, leaving developers holding the bag on billions of dollars in stalled projects. But here's what nobody's really talking about. While Premier Doug Ford promised 1.5 million new homes by 2031, Ontario managed just 94,000 housing starts in 2024. That's 31,000 homes short of what they needed just to keep up with population growth, let alone close the housing gap that's been building for years. If you're a first-time buyer trying to figure out when to jump into this market, if you're an investor watching your pre-construction deposits disappear into legal limbo, or if you're a homeowner wondering if your property value is about to crater, this breakdown is going to cost you serious money if you don't understand what's really happening. Before we dive in, make sure to hit that like button and subscribe to the channel because we're bringing you the real numbers behind Ontario's housing crisis, the data the government doesn't want you to see, and the opportunities that smart money is already positioning for. Right, let's get into it. Look, what we're seeing in Ontario right now isn't just a market correction. It's a complete systematic failure at multiple levels, and the numbers are absolutely brutal. Let's start with the most shocking statistic. New condo sales in the GTA plummeted to just 4,590 units in 2024. That's a 64% decline from 2023 and represents the lowest volume since 1996. To put that in perspective, during the peak years of 2016 to 2017, Toronto was selling over 20,000 new condo units annually. We've fallen off a cliff. But here's where the regional differences get really interesting. While Toronto's condo market is in complete freefall, cities like Ottawa saw a 43% drop in overall home sales, and even smaller markets like Kingston are experiencing 25–30% declines year over year. The contagion is spreading across the entire province. Now, let's talk about what's happening with buyers walking away from deals. Industry insiders are reporting that contract cancellation rates have increased by 500% compared to pre-2022 levels. We're talking about buyers forfeiting deposits of $50,000, $100,000, even $200,000 rather than complete their purchases. The mathematics here are terrifying for developers. Here's a real calculation that shows you the scope of this problem. If a typical condo development has 300 units with an average deposit of $75,000, and we're seeing 30–40% cancellation rates, that's $6.75 million to $9 million in deposits that developers thought they could count on, now gone. Multiply that across hundreds of projects, and you're looking at billions in financing gaps. The demographic breakdown is equally striking. First-time buyers, who made up 52% of purchases in 2019, now represent just 31% of the market. Meanwhile, investor purchases have dropped from 35% to just 18% of transactions. The entire ecosystem that drove Ontario's housing boom has essentially collapsed. What's really wild is the geographic disparity within the province. While Toronto proper is seeing these massive declines, some rural areas are still experiencing 15 to 20% year-over-year price increases. But here's the catch. Those rural markets are tiny. We're talking about maybe 200–300 transactions annually in some of these communities, compared to Toronto's historical 80,000-plus annual sales. The price corrections are equally dramatic but vary significantly by property type. Detached homes in Toronto are down an average of 18% from their 2022 peaks, while condos have fallen 23%. But pre-construction condos? Those are showing paper losses of 35–40% for buyers who purchased in 2021–2022. Here's where it gets really serious. The carrying costs for buyers who purchased at peak prices. Let's do the math on a typical scenario. Someone bought a $900,000 condo in 2022 with a 5% down payment. Their mortgage payment at today's rates would be approximately $4,100 monthly, plus maintenance fees of $650, property taxes of $400. That's $550 monthly for a property now worth maybe $650,000. They're underwater by $250,000 and paying nearly $63,000 annually just to live there. The construction industry numbers tell an even more dramatic story. Ontario had 15,000 active construction cranes in 2019. Today, fewer than 6,000. Construction employment in the residential sector has dropped by 38% since 2022, representing about 95,000 jobs lost directly in home building. But the really brutal part about all this is the generational impact. Millennials who finally saved up for down payments are now completely priced out again, not because prices are rising, but because lending has tightened so dramatically that even with lower prices, they can't qualify for mortgages. The stress test requirements mean that a household needs to qualify at rates of 7.25 to 8.5%, making a $600,000 home require an income of roughly $140,000 annually. Now here's the part that's going to keep Premier Ford awake at night, and it's something most people don't see coming. This isn't just about housing, it's about the complete unraveling of Ontario's economic growth model. The province has built its entire economic strategy around population growth and housing-driven GDP expansion. Ontario has been adding approximately 300,000 new residents annually over the past 3 years. But here's the math that's terrifying government economists. Each new resident requires 0.43 housing units when you account for household formation patterns. That means Ontario needs roughly 129,000 new homes annually just to house new arrivals. But we're only building 94,000 homes total, and that number is dropping. The gap between housing demand and supply is now growing by 35,000 units every single year. At this rate, by 2030, Ontario will have a housing shortage of approximately 350,000 units beyond what already exists. Here's what makes this fascinating. While everyone's focused on Toronto, the real crisis is developing in mid-sized Ontario cities. Places like London, Hamilton, and Waterloo are seeing population growth of 4 to 6% annually, but housing starts have actually declined in these markets. London, for example, welcomed 18,000 new residents in 2024 but started construction on just 2,800 housing units. The financial cascade effects are already starting to show up in ways most people haven't connected yet. Municipal revenues in Ontario are down 12% year over year because of declining development charges and land transfer taxes. Cities like Mississauga and Brampton, which built their budgets assuming continued development fee income, are now facing potential service cuts or tax increases of 15 to 20%. But here's where it gets really serious for ordinary families. The rental market has become the pressure release valve for this entire crisis, and it's reaching a breaking point. Average rents in Toronto have increased 28% year over year, while vacancy rates have dropped to 0.7%. That means for every 1,000 rental units, only 7 are available at any given time. Let's talk about what this means in real numbers for different groups. A typical family earning Ontario's median household income of $84,000 can now afford a maximum rent of $2,100 monthly, using the 30% rule. But the average 2-bedroom apartment in the GTA now rents for $2,850. That's a gap of $750 monthly, or $9,000 annually that families simply don't have. The really brutal part about all this is what's happening to people who thought they were financially secure. We're seeing a new phenomenon: equity prisoners. These are homeowners who purchased in 2021-2022 and now owe more on their mortgages than their homes are worth. But they're also paying mortgage payments so high they can't save money to ride out the downturn. Here's a specific example. A couple bought a townhouse in Oakville for $1.2 million in early 2022 with 10% down. Today, that property is worth approximately $875,000. Their mortgage payment at renewal will be roughly $6,200 monthly, compared to the $3,800 they were paying initially. They can't sell without bringing $325,000 to closing, money they don't have. They can't refinance because they're underwater. They're trapped. Industry data suggests there are approximately 185,000 households across Ontario in similar situations, owing more than their homes are worth while facing payment increases of 40–60% at renewal. That represents roughly $1.8 billion in potential mortgage defaults over the next 3 years. The construction financing crisis is creating its own set of problems. Developers who started projects in 2022–2023 are finding that 30–40% of their pre-sales are walking away. But construction costs have increased 35% since those projects began, meaning even completed units need to sell for prices significantly higher than what the remaining buyers contracted for. This is creating what economists call a completion crisis. Developers can't afford to finish projects at contracted prices, but they also can't increase prices without losing the remaining buyers. The result? Projects are being abandoned mid-construction, leaving buyers with lost deposits and municipalities with half-built developments. Chatted. Section 3. The policy response and external factors. 5 to 7 minutes. Now let's talk about how government policy is both trying to solve this crisis and making it worse at the same time. Premier Ford's response has been a mixture of panic, denial, and throwing money at problems without addressing root causes. The centerpiece of Ford's housing strategy is the promise to build 1.5 million homes by 2031. But let's break down why this target was always fantasy mathematics. To hit 1.5 million homes over 10 years, Ontario needs to average 150,000 housing starts annually. The province has never achieved this target in its history. The previous record was 127,000 starts in 1987. But here's what's really happening with provincial policy. Ford's government removed key environmental protections from the Greenbelt, thinking this would unlock land for development. The result? Massive public backlash, legal challenges, and ultimately most of those decisions were reversed. Meanwhile, the real constraint on housing, municipal zoning, and approval processes remained completely unchanged. The federal government's role in this crisis can't be ignored either. The Bank of Canada's interest rate increases from 0.25% to 5% have essentially shut down the housing market. But here's the policy bind. Inflation in Ontario is still running above target at 3.2%, meaning rates likely can't come down quickly enough to save the housing market. Meanwhile, the federal government's immigration targets are directly conflicting with housing reality. Canada is planning to welcome 485,000 new permanent residents in 2024, with approximately 40% settling in Ontario. That's 194,000 new permanent residents, plus temporary foreign workers, international students, and asylum seekers. The total new population in Ontario will likely exceed 350,000 people this year. Here's where the federal-provincial blame game gets really interesting. Ford has been demanding that Ottawa remove the HST from new home purchases, which would save buyers about $60,000 on a $800,000 home. The federal government has agreed to match provincial HST removal, but only if Ford removes the provincial portion first. Neither level of government wants to absorb the revenue loss alone, so buyers continue paying the tax while politicians play chicken with billions in tax revenue. The municipal level is where the real dysfunction lies. Cities like Toronto have approval processes that take 18 to 24 months for straightforward projects and 3 to 5 years for anything complex. Development charges in the GTA now average $87,000 per unit for condos and $124,000 for single-family homes. These charges alone represent 15 to 20% of final housing costs. But here's what nobody's talking about: the infrastructure crisis that's making all of this worse. Ontario's electrical grid is already operating at 95% capacity during peak periods. The province needs $25 billion in electrical infrastructure upgrades to support the density increases required to hit housing targets. but there's no plan to fund this and no timeline for completion. Water and sewage infrastructure is equally constraining. The region of Peel, which includes Mississauga and Brampton, has issued development moratoria in several areas because sewage treatment capacity is maxed out. You literally cannot build more housing in parts of Ontario's fastest-growing region because the toilets won't flush. Transportation infrastructure is the third piece of this puzzle. The Ford government has committed $70 billion to transit expansion, but most projects won't be completed until 2030-2035. Meanwhile, traffic congestion is already costing the average GTA commuter $100 to $800 annually in lost time and fuel costs. Now let's talk about the external economic factors making everything worse. Construction material costs have stabilized, but remain 35% higher than pre-2020 levels. Labor shortages in skilled trades are pushing wage premiums to 40–50% above historical norms. Insurance costs for high-rise construction have tripled since 2020 due to a series of major building failures and subsequent lawsuits. The really fascinating part is how these factors interact. Higher construction costs require higher sale prices, but higher interest rates reduce what buyers can afford to pay. The result is a scissors effect where viable projects become impossible to finance, even in a housing shortage. But here's what makes this fascinating. While most of the housing market is in free fall, certain players are positioning themselves to make enormous profits from this crisis. First, let's talk about who's actually winning right now. Large institutional investors, pension funds, REITs, and private equity firms are raising billions to buy distressed real estate. Brookfield Asset Management just closed a $7 billion fund specifically targeting Canadian real estate opportunities. These firms can afford to wait out the downturn and buy assets at 30–40% discounts. The rental housing sector is experiencing a massive boom. Companies building purpose-built rental apartments are seeing 95% to 98% occupancy rates and can charge premium rents because there's literally nowhere else for people to live. A company like Hazelview Investments is generating returns of 12% to 15% annually on new rental construction compared to 4% to 6% for traditional condo development. Here's a specific opportunity that smart money is already exploiting: distressed pre-construction contracts. Buyers who put $100,000 deposits on $900,000 condos in 2022 are now walking away rather than complete purchases on units worth $650,000. Sophisticated investors are buying these contracts from desperate buyers for $20,000, $30,000, then completing the purchases and immediately flipping or renting the units. The math on this strategy is incredible. An investor buys a contract for $25,000, pays the remaining $550,000 to complete the purchase, total investment $575,000, and immediately owns a unit worth $650,000. That's $75,000 in instant equity plus rental income of $2,800 to $3,200 monthly. But here's where it gets really interesting for smaller investors. The condo hotel market is exploding. Buildings designed as condos are being converted to short-term rental operations because traditional hotel construction has completely stopped. Investors buying units in these buildings are seeing cash-on-cash returns of 18% to 22% annually. The renovation and retrofit market is another massive opportunity. Ontario has approximately 650,000 single-family homes built before 1980 that need major energy efficiency upgrades. The federal and provincial governments are offering grants of up to $40,000 per home for these upgrades, creating a boom in renovation contractors who understand how to navigate the rebate programs. For builders who can survive this downturn, the opportunities are enormous. Construction companies that maintain their workforce and equipment while competitors shut down will be perfectly positioned when the market recovers. The number of active residential builders in Ontario has dropped by 35% since 2022, meaning less competition for the survivors. Here's what's wild about the land market right now. Developers who overpaid for land in 2021-2022 are quietly walking away from purchase agreements, forfeiting deposits rather than complete transactions. This is creating opportunities for buyers with cash to acquire development sites at 2018-2019 prices. The emerging build-to-rent sector represents maybe the biggest opportunity of all. Purpose-built rental construction is eligible for preferential financing, accelerated depreciation tax benefits, and much more stable cash flows than traditional condo development. Companies pivoting to this model are raising capital at unprecedented rates. But here's what makes this fascinating: the geographic arbitrage opportunities within Ontario. While Toronto real estate has cratered, cities like Ottawa, London, and Kitchener-Waterloo still have positive supply-demand dynamics. Investors who understand these local markets can find properties with 8 to 12% cap rates, compared to 3 to 4% in Toronto during the boom years. Look, here's what the smartest people in Canadian real estate are telling their private clients about what comes next, and why timing your next move correctly could make or cost you six figures. RBC Economics is forecasting that Ontario home prices will bottom out in Q2 2025, with total declines of 25–30% from peak levels in the GTA. But here's the key detail. They expect prices to remain flat for 3 to 4 years after hitting bottom, meaning no meaningful recovery until 2028 to 2029. Scotiabank's housing team has an even more pessimistic view. They're projecting a 35% peak-to-trough decline in condo prices, with detached homes falling 20 to 25%. Their base case scenario sees Toronto prices returning to 2019 levels and staying there until at least 2030. But here's where the expert predictions get really interesting. CMHC's latest analysis suggests that rental rates will continue increasing 15 to 20% annually through 2026, even as purchase prices fall. This creates a unique situation where rental properties become incredibly profitable while purchase prices are declining. National Bank's housing strategist is forecasting what they call a K-shaped recovery. Luxury properties and investment-grade rentals will recover quickly, while entry-level condos and suburban homes will remain depressed for years. This creates specific opportunities for investors who understand the bifurcation. So what should you actually do if you're in different situations? If you're a first-time buyer, here's your action plan. Wait until Q2 2025 before making any purchase decisions. Use this time to save a larger down payment. Aim for 15 to 20% instead of the minimum 5%. Focus your search on areas with good rental potential, because you may need to rent out part of your property to afford the carrying costs. If you're an investor, the opportunities are enormous but require capital and patience. Target distressed pre-construction contracts, purpose-built rental properties, or single-family homes in rental-friendly neighborhoods. Avoid anything requiring construction financing or depending on appreciation for returns. If you're a current homeowner facing renewal, start planning now. If your mortgage renews in the next 18 months, speak with a mortgage broker immediately about options. Consider extending your amortization to reduce payments, even if it costs more long-term. If you're significantly underwater, explore legal options before walking away from your mortgage. For people looking at real estate as a business opportunity, this is the time to get licensed, build relationships with distressed sellers, and prepare for the opportunities that will emerge over the next 2–3 years. The agents and investors who position themselves correctly during this crisis will make generational wealth when the market recovers. The key is understanding that this isn't just a typical real estate cycle, it's a structural shift in Ontario's housing market. The easy money, speculation-driven boom is over. What comes next will reward people who understand fundamentals, have access to capital, and can execute strategies that generate cash flow regardless of property appreciation. The government's 1.5 million homes target isn't completely impossible, but it would require policy changes so radical that they're politically unlikely. Realistically, Ontario will build 800,000 to 900,000 new homes by 2031, leaving a shortage of 400,000 to 500,000 units. That structural shortage will eventually drive prices higher again, but probably not until the late 2020s. The key is understanding your numbers, knowing your local market inside and out, and being ready to act when the right opportunity comes along. This crisis is reshaping Ontario's housing market permanently. Make sure you're positioned on the right side of that change.